On Wall Street, top investors watching your money. Let's bring in Banríon Capital Management CEO Shana Sissel. John Lonsky also with me. John, I want to start with you. You've got a positive outlook for holiday sales. I want to get your reaction to what we just saw, because you say eventually faster spending growth is going to be the source of our own demise. But from what Jeff is looking at, people are physically going to the stores, and I think there is a trend this year.
Yes, I think we're going to have a very jolly holiday shopping season. You know, we have had this improvement in consumer confidence because of the election results. People want to go out there. They want to spend. They feel confident about the future. Now, of course, the problem is once those bills come rolling in, those credit card bills in the month of January and February, they may pull back a bit. What bothers me looking ahead is simply this. We have nearly a full employment economy. And yet we believe we're going to have growth maybe in the upcoming year, 2.5% to 3%. At least that's what the Trump administration is telling us. I don't know if we could have rapid growth for a long period of time without putting upward pressure on wages. And it's going to be those wage pressures. And we saw a little bit of evidence of that with with the threat by Amazon workers to take a labor action. If we have a faster wage growth moving forward, inflation comes back, and believe it or not, we're not going to be looking at rate cuts anymore. We're going to be bracing for Fed rate hikes.
Well, I want to get to the Fed with you, Shana, but really quick, I want to get your take on, there's this article in the Wall Street Journal this morning talking about that a lot of these retailers now are going out and advertising to consumers and saying, our prices are low now, take the deal now because tariffs are coming. They're actually using the tariff threat from Donald Trump to sell more products today. What do you make of that?
It's smart marketing on their behalf because they're playing on the fact that the American people don't understand the tariff threat, don't understand or don't reflect on the first Donald Trump administration where tariffs were a bargaining tactic. And there is no reason to believe that's not the case today, that they continue to be a bargaining tactic, and highly unlikely that they will be affected in the retail sense, unless they're doing a lot of buy-in from China. So I think it's a lot of a big deal about nothing, but it is smart in terms of marketing as far as I'm concerned.
Yeah, that's the comment I made earlier as well. I agree with you that this is smart advertising, and with social media, companies can put these words out there instantaneously. They don't need to make a television commercial about it anymore. So Shana, let me stay with you. Let's look at the yields this morning. So we have the October PCE report that rose to 2.3% annually. We got that data Wednesday morning. Futures market pricing in a 67% chance for a rate cut at the Fed meeting next month. That's the 17th and the 18th. Shana, what are you expecting?
Well, I expect that the Fed will hold pat. I would be surprised if they made another cut. In fact, I would be concerned if they did. It's not out of the question. I've been wrong before. I didn't expect a 50 basis point cut to start. But it would be surprising to me. I think that the Fed should hold pat here. It's a new administration. They should sit back and kind of see how things go. There's no reason to have another cut right now. In fact, if anything, the indications have been that that might be a bad idea. As you pointed out, the PCE numbers rose, and the inflation does not appear to be continuing to move downwards as we have full employment. And if we have strong retail sales in the holiday season, none of those things are supportive of an additional rate cut. So I'm a big believer that the Fed should hold pat right now. And it was already pointed out, if things start to move in the direction that some of us are anticipating, a rate hike might be the smarter move as opposed to a rate cut.
Interesting. John, weigh in on that.
Well, I think Shana, her words of caution, I think, are very well taken. And, we're going to have to pay a lot of attention to next Friday's November employment report. The Fed has told us repeatedly that if the labor market continues to soften, there is room for a rate cut. I happen to agree with that. And it might well be that we do get this rate rate cut in December. But according to Fed funds futures, according to that 2-year Treasury yield, we may find that the Fed halts rate cuts until it has more evidence that the labor market is softening, that domestic spending is slowing by enough so that they're opening up the way for a slower rate of price inflation, opening up the way to getting to core inflation at about 2%. But meanwhile, you have a lot of enthusiasm about next year's economy.
Yeah.
You have that enthusiasm in the equity market, the bidding up of equity prices. Well, let's see who's right. But if the equity market is right, the economy does well, you are not going to be looking at a Fed funds rate bottoming under, say, 4.38%.
All right. John's going to stay with us all morning. Shana, it's great to see you.